Inflation expectations are rising, but this week's inflation data came in below survey. We'll talk rates and inflation with Professor Mark Guthner today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest. I'm joined, as always, on Fridays by Professor Mark Guthner of Rutgers. I would say New York Fed Reserve President John Williams commented that he expects slower growth, higher unemployment, and higher inflation due to the U.S. tariffs. St. Louis Fed President Alberto Mosellam warns of rising inflation and a weakening labor market, and these guys are mirroring what economists are saying on Wall Street. But in the midst of all of that, CPI and PPI data came in this week, and those numbers were actually below the survey. Mark, what are we supposed to make of the apparently conflicting data and remarks from economists?
Okay, well, I guess I could quote you from an earlier conversation that the one thing economists are good at are being incorrect in their forecasts. So that's a nice way of saying what you just said earlier.
Yeah. There's a joke. There's a joke about economists. I don't know if the viewers of this program have heard it, but there's an engineer and a physicist and an economist, and they're trapped on a deserted island, and they have only an unopened can of beans, and apparently no mechanism to open it. So the physicist says, I have a suggestion. What we should do is we should start a fire. We'll rub some sticks together, we'll start a fire, we'll drop the can of beans into the fire. Fire is going to heat up the contents, and eventually the can will explode, and we will get to the contents therein. And the engineer says, well, that's really not a very elegant solution, and proposes, going around the island and trying to find suitable materials to make a device whereby they could somehow extricate the contents of the can. And the economist says, well, we're not going to be able to find all of those needed materials that you suggest. That's not a practical solution. And the physicist's solution isn't very practical either, because when that can explodes, the beans are just going to blow all over the place. We're going to lose tons of them. It's not going to be much food for us to eat. And so his two compadres say, I suppose you have a better suggestion? And he says, yes. Assume we have a can opener.
Yeah, assume we have a can opener. And
economists and their assumptions, and then the practical realities that we're confronted with. That's a well-known joke about economists. Or I'm not sure I told it precisely the way it was told originally, but that's the gist of it.
Yeah, well, this is the problem with economics, is that if 20 engineers get together and build a bridge or build a building or something like that, they come up with a great solution, and they will have a sturdy bridge or a sturdy building. And all things work. But the economics as a profession has never predicted a recession. Yes, there are individual people here and there that are sort of off the run that will predict a recession. But as a profession, they can't say, well, this is what's happening, and we'll have a recession and so forth. What they do have is that group of economic advisors that after the fact will tell you when they had a recession in the past. So not a whole lot of help from my perspective, and certainly not for most people as an investor, because if you're an investor, you should think about how well the company is going to do if you're an individual stock investor. A good company is going to find a way to do business no matter what the economic environment is. And so we're going to see that with all these tariffs, as people are going to change their supply chains a little bit. I think, I've been thinking a lot more about this. and why um, Trump at first put tariffs on everybody, and then he continuously kind of gives people a reprieve. I think what he's doing is he's finally saying we're serious about doing this, and if you want to talk about this, we'll give you time to, solve the issues, solve the logistics issues. And I don't think, the Vietnams, and, the Brazils and the Cambodias, those are not really what he's too interested in. I think what he wants to fix is the relationship with China, Japan, Korea, and Western Europe. Those are the countries that he's really um, needs to address. Now, why does he pick on the other little countries too? Because what I think is going to happen is they'll drop their tariffs to zero. We'll drop ours to zero for them, or some nominal number. Maybe both sides take 10%, something like that. I don't know. But what they don't want is those smaller companies to be backdoors for China. So, for example, there were some tariffs on some Chinese products, aluminum products coming into the U.S. This one I want to say, if memory serves, something like 5 or 6, 7 years ago. And to avoid those tariffs, they just bought a big warehouse in Mexico, shipped the products into Mexico. Inside that warehouse, they put them in a new box, and out they came the other side, tariff free. So I think that's why they need, like when Vietnam said, okay, we'll drop ours to zero. Why they didn't say, okay, you're off the list. Don't worry, but you don't have to worry anymore. So I think what's going on is that those additional conversations are going to be that you can't be a backdoor to Europe or China or the other big modernized Asian countries, and so it's just a matter of working out the details. It takes governments a while to do their thing, and so ultimately I think they're going to be there, and I'm not taking all this bluster as seriously as most people in the news are, and certainly not as seriously as those people that sell everything and ask questions later, which is what we saw. What was it last week with the 3,000 point drop in the Dow Jones Industrial Average? That was a bit extreme.
It's interesting. You were talking about
Or that was up.
economists and predicting recessions, and in fact, I think it was Paul Samuelson at MIT who said at the time that economists had successfully predicted 9 of the last 5 recessions. And what I thought was interesting about that was that, economists were doomsayers for what was going to happen more often than it actually did. That the negative outcomes actually did happen. I think, everyday people who are going about their lives probably understand why this is so, because they don't sit and spend all of their time toiling about policy minutia. Instead, they just go about trying to do the best that they can with whatever it is that they're doing, given the circumstances. So what I thought we might talk a little bit about is some very unusual and disconcerting price action that we have seen over the course of the last week. I think we started to talk about it a little bit last week. But one of the things we've seen is that the long end of the curve, rates went higher. And you actually had predicted that more than once on this podcast. And that apparently surprised a lot of people. It didn't surprise you, but it surprised a lot of people who said, well, normally you would expect rates to decline. The reason you would expect them to decline is because if you think that there's policy coming that is potentially recessionary, then that lowers your growth forecast. It might lower your inflation forecast. And on top of all of that, if the equity markets are being disrupted at the same time that takes place, then there would be a flight to safety.
Mm-hmm.
And a flight to safety usually involves the dollar, and it involves U.S. Treasuries. That has not been true this time. We've seen enormous rate volatility at the long end, and the dollar has weakened. What did a lot of people get wrong? And do you think we need to be concerned about the volatility in, say, 10-year rates?
Yeah, well, what I think they got wrong is it's um, a problem of behavioral finance. People kind of suffer from what's known as the recency effect, and that is they take a look and see what happened over the last 1, 2, or 3 years, some small period of time, and then they extrapolate that and say that's normal. So I don't look at that. I look at, well, what had happened over the last 100 years or 200 years, and that to me is normal. And then where do we stand today relative to that long history? So that's my approach. And when I think about bonds, if you're going to buy bonds, even if they're treasury bonds, you should be getting some kind of risk premium. A 30-year bond has a duration of, I don't know what the calculation is right now, but I'm going to guess it's something like 25. What does that mean? That means if interest rates go up by 1%, the value of a 30-year bond is going to go down about 25%. So investors are taking, now there's a convexity effect that mitigates that a little bit. So maybe, but let's keep that to the side. So people are taking some kind of liquidity risk, and they should get that. Now, the traditional market risk premium of stocks over treasury bills is over the long term, I think since the 20s, is something about 7%. So take a treasury bill rate, add 7% to it. That's kind of what an expected return on stocks might be. For bonds, I'm going to suggest that's probably 2 or 3%. So, but let's just say it's 2. And if the inflation rate is 3.5%, and if you get a 2% risk premium, I'm going to add that. That's 5.5%, and you should be getting that return after tax. And let's say the average tax rate for a person is 30%. A little bit of Fed, a little bit of state. So we take that number and divide it by 0.7, and you get 7.85%. So when I see rates down here at 4%, to me, they're not giving you a good 30-year bonds are not giving you a good deal. And so they need substantially higher rates. Part of this may be my particular recency effect, but my recency being 40 years. When I started trading bonds in the latter part of the 1980s, the 30-year bond was something like 12%. And those bond prices would change by points every day, 1 point, 2 point, 3 point. It was a trader's dream. If you wanted to churn and burn in that day trade, that stuff, which I often feel like, when people say, oh, look at how volatile the bond market is now. Well, the bond market is nowhere near as volatile as it was when I started in the business in, let's say, the first 5-7 years that I was trading bonds. This super suppressed interest rates and bond volatility is really something that started, I'm going to guess, somewhere around the collapse of long-term capital management. That's when the Fed really started to really get involved with the market. So just to solve that problem, for those that don't know, long-term capital management was a hedge fund that blew up, and it put a lot of broker dealers at risk. And so the Fed coordinated a bailout. They didn't bail out, but they coordinated the industry to bail out. But then when we had the dot-com bubble and crash, that's when the Fed really started to intervene in markets much more heavily. And they've been doing that ever since. And that's why we always say we got this Fed put, which suppresses volatility. And that's sort of where we are today.
I put up the 10-year. This goes back over 60. Oh, I have no desktop share. I've just been told that's probably my screw up. We did not go through our pre-flight checklist today. So take me 1 second to fire up the requisite machinery. hopefully, if I do this right. So let's see if this works. 3, 2, 1. That looks like that's connected. Don't know if there's a screen share that we have now. Okay, so I have the 10-year rate here, and this goes back to the early 1960s, and it reflects exactly what you were just talking about, which is, so for those that don't know, the collapse of long-term capital management took place right around here. So I'm just going to put a little box around that. Okay.
Yeah.
So you can see that rates came sharply lower. The trade that long-term capital management, which had more than one Nobel laureate working there, it was a hedge fund that was founded by John Merriweather, but they also employed Robert Merton and one other Nobel laureate. I don't remember. Oh, was Scholes there?
Scholes
also?
was part of the game, yeah.
Yeah, so Myron Scholes and Robert Merton. That's the same Scholes that with Fisher Black, who did not get a Nobel Prize but would have had he been alive because it's not awarded posthumously, is part of that most famous equation, the Black-Scholes formula. Now, these guys were very highly thought of quantitative traders, and I'm sure very smart guys. But at the end of the day, the trade that they had on was not all that sophisticated, really. People didn't investigate what they were doing so closely. And this has some relevance, by the way, to the current state of affairs. What they were effectively doing was shorting bonds, mostly U.S. Treasuries, for example, to buy higher yielding instruments abroad. So it's just a big spread trade. And the logic to that, and there probably is some reasonable assumptions that are being made here, that the effective yield of some of these higher risking sovereigns over the course of time was greater than that of U.S. Treasuries, and they should therefore be able to capitalize on the difference. And that by itself probably would have been fine, except that, of course, because of the nature of the trade and the people who were doing it, they were allowed to deploy a lot of leverage to put this trade on. So if you can make 150 basis points, dollar for dollar, that's 1.5%. Well, 1.5% per year doesn't sound very attractive. But 15% a year sounds quite attractive, and you could do that if you had that trade on 10x, or if you wanted 20% more leverage. And if you have banks that are willing to go along with you and extend you that leverage, then away you go. And these guys were well thought of, that they were able to convince people that they had very sophisticated risk systems, and they were able to put this trade on in good size. And the reason I mention this is because, of course, when people talk about things like the basis trade now, in general, whenever you get into circumstances where you start seeing things chop around and some unusual behavior, and people talk about deleveraging, that's what they're talking about. They're talking about positions that people have on that under normal circumstances might not be all that risky. They're fairly plain Jane. They can be deployed with leverage. But when markets start chopping around, they may need to unwind them either because their capital requirements increase, or because they see some losses and need to liquidate assets to satisfy those losses. Very often you need to do that by trading the most liquid instruments in your book, which would, under most circumstances, be U.S. Treasuries. So you sell those first, and then maybe if having liquidated those, you move, you basically sell the best stuff first, and because that's where you can find a bid. And that, I think, is one of the things. Are you concerned about the possibility that what we're seeing here is actually the tip of a large levered trade unwinding, or do you think this is something that we don't need to be as concerned about?
At this stage of the game, I kind of think we're at the sort of the eighth inning of the rise in bond yields that started, what was that, a year and a half ago? So I think we're maybe it's seventh inning, but it's somewhere around there. We're about to have, I think, a sell-off that's going to um, sort of freak people out because it'll be the path of that most people don't think is possible. And so there'll be a bit of panic, a bit of washout, and then I think bond prices and yields stabilize. They'll bounce, they'll stabilize for a while. But I think that process that started of the unwind of the zero interest rate policy just has a little bit more to go for people um, to realize that that game is truly over.
So maybe that can bring us to our first question. Monday morning quarterback, although he's not referring to trading the fixed income market specifically, said that he's thinking of selling call spreads on IWM. IWM, for those that don't know, is the ETF that tracks the Russell 2000. The Russell 2000 are the small cap stocks. You know, more commonly when you see me looking at things, I'm usually looking at either the S&P 500 or the Russell 1000, which are the two probably best known cap-weighted large cap indices.
You had to pull those up. You had to put those up, Mike, because as I recall, we're down about 30%, and the Russell.
Yeah, we're down quite a lot. Yes. So we're gonna go like this. Here we are. We're down 25% in IWM, give or take, from the peak. So it's interesting. The Russell topped out last year, whereas the large cap indices topped out this year. Yeah. Right. So we saw our all-time highs in the S&P around February 19th, if my memory serves me correctly. And actually, we don't need to rely on my memory because I can just add it to this. Now, I think people should remember, as we think about the Russell, that the Russell was considered... I got to get rid of some of these moving averages because that's a lot of lines to look at. That a lot of folks considered the Russell, the small caps, to be the Trump trade at first, right? That was the Trump trade. It got a huge bid when it began to look increasingly like he was going to win the election.
Yeah.
The idea being that his policies would generally be good for smaller businesses.
Yeah.
And to a degree, I actually believe that's true. I think he favors less onerous regulation for a small business, and I think he favors taxes. And in fact, actually, a lot of administration officials, whether it's Lutnick, whether it's Bessent, and whether it's Trump himself, have all said recently that they want this administration to be about Main Street and not about Wall Street. So they're interested in labor, they are interested in the middle class, and they are interested in small business. And they are less interested in NVIDIA's advanced chip sales to China. Although apparently there was a conversation between NVIDIA executives and Trump, and he decided that he wasn't going to be as restrictive on that as he had apparently at one time thought he would be. So down 25%. What are your thoughts on the Russell here? And what do you think about selling upside call spreads? I guess one of the things we should probably take a look at is where volatility is.
Yeah.
And I'm just going to take a look at implied volatility. Let's go out. Let's say 2 months. I'm going, and one of the reasons I'm going out this far, normally I would say if you're trying to sell premium, there's a sweet spot. And actually, I know, Mark, you had a presentation that showed sort of the optimal area to be short options. And one of the things that we know is that, yes, options decay as a percentage of their own value fastest as expiration approaches. But as a function of the price of the underlying, actually, if we can imagine that expiration is my left hand here, you have an option that expires out here. Basically, it goes up and up and up and up, and then all of a sudden it falls off sharply and goes down like this. And the reason is because once an option becomes very cheap, even if it's decaying very rapidly as a percentage of its own value, its value relative to the underlying is very low. And the other thing I would say is that in a marketplace like this one, where I got uneasy, and I want to first admit that I have been selling 0 DTE in SPX earlier this week. Worked out on Monday and Tuesday. I stayed out of it on Wednesday, quite fortunately, it should be said.
Mm-hmm.
And then I was back in again on yesterday. Yesterday was a complete push. And I was evaluating the intraday volatility. But the reason I favor this is because you have such a strong bid to this longer dated vol that you're going to get very attractive rates of theta, I think. And in addition to that, you could get a vol crush, right?
Yeah.
You can see just how much higher this volatility is. Let's go back a little bit further in time, and we can see, okay, so we had, remember that big market swoon last August? It's still well above that. Let's now go back 2 years and see where we're at. It's still, even net of some recent declines, it's at 2-year highs. You have to go back 5 years to see circumstances where, the vols were in this neighborhood, right? So we're about 35. Let's call it 35. This takes us back to the pandemic.
Yeah.
2020. And things are always darkest before the dawn. I said that on Fast Money at part of my closing trade. I said, maybe people want to get long Delta here because the stock is basically given back all of its gains. The CEO of Air France KLM, with whom Delta has a joint venture, said earlier this week, and he's been in the business for 35 years, that their load factors are the highest he's ever seen. That demand at the high end for the high end traveler, so Air France KLM doesn't actually offer travel within the United States. If you book, you actually end up on a Delta plane. And he said there is sensitivity in the economy cabin, but he said that economy cabin, if they want to fill the seats, he said they just have to reduce prices a little bit, and they fill them up. And I thought that was interesting. That doesn't mean things can't get worse. It doesn't mean that those consumers can't, weaken still further. But it does suggest that, there is some healthiness to that business that, people are very panicked about. And that weakness, it should be said, you have to lower prices, excess capacity, maybe demand slacks off a bit. But fuel prices have also come down.
Yeah.
And that's a major thing, right? And they've already sort of absorbed these higher wage costs. Like they had to renegotiate all of these contracts recently. All the airlines did. And they had to pay substantially higher wages. But that's kind of baked in the cake now. So
I want you go back to your previous chart of Russell or IWM, whichever that was.
This is the vol, and let me put in the IWM. How far back would you like to go?
Just from the peak, our recent peak. The point I wanted to make was that one of the disciplines I look at when I just do macro is I look at Elliott waves. So you can see from the peak, there's a wave 1 down, there's a consolidation, that's wave 2, and then there's another wave down, that's a 3, then there's a consolidation, then there's wave 5. So a 5-wave move is considered impulsive in that discipline. When 5 waves are complete, you get some kind of rebound or correction to that 5-wave move. A typical,
so that would suggest back to 200ish.
Yeah. So it typically
10% rally.
Yeah, typically bounces. Well, they have the Fibonacci ratios, but one of the other cluster areas is it goes back to the previous 4th wave, which was what you were pointing at just a moment ago. So how much is that? Is that I don't know what that's probably a 10% bounce.
That's a 10% bounce. And that also represents about the 50% Fibonacci retracement for what it's worth. Looking at this.
So that it's just, I would be a little nervous to press this short here. It's tempting to do, and I think that's why these bottoms come in, and then they get that rip roaring correction, and then ultimately that next leg down comes around, but it's roughed up the short sellers in this case by doing that. So it's not a trade I would favor doing. And I
But we want a short vol if we
Yeah.
think it's elevated.
Yes.
What do you think about short strangles targeting the move that you predict? So normally we might go out 45 days,
Mhm.
sell a 20 delta strangle if we think vol's overpriced. That's typically where I would look.
Yeah.
One of the things that people can do, and it's probably worth considering, is that if you want to engage in that strategy, but you also are willing to take a little bit more of a directional bet, then you can adjust your strikes accordingly. For one thing, when implied volatility is much higher, you're going to find that those 20 delta strangles are much farther apart than they were. That's just a natural function of, the standard deviation increases. And remember that a 20 delta strangle is going to be about the expected move apart. And the expected move is going to be about 80% of the standard deviation. So about 60% of the time you're going to expect to be within the boundary of a 20 delta strangle. Whatever period of time you're looking at, assuming that the implied volatility is representative of the underlying process. Whole separate question, but
Yeah.
there it is. So let's just say 70 days, that's kind of far out. 49 days, that's the end of May. Why don't we start with this? And we'll assume that we sold a strangle. So I'm going to switch that to a call. Now let's just take a look at the 20 delta strangle as a starting point. And then we'll approach. So that would be we'll check that out. It's interesting. The 20 delta call is actually the upper end of that boundary. It's up about 10% pop from here.
Okay. Good.
Right? Okay. And the downside put would be 163, so let's just think about that for a second. So 163.203, a $40 wide strangle yields $5.50, give or take, over the course of 49 days. So you got $5.50 over the current spot price of 183 spot 2. So a 3% yield over 49 days. All right. So we'll divide that by 49. So that's, So that works out to 22.5-ish percent annualized rate of return. You would get long at 163, not including the premium, but it would actually be 158-ish on the downside net of the premium collected, or you get short at 209. Now let's go back to our chart, which showed the fibs, and talk about your Elliott waves. So that's it right there. See, this is 208.30. So that's your upside break even. And your downside break even would be 158, which is substantially lower than the recent lows. So going back to my earlier point, what you could do, and what I think is probably not a bad idea, we see here that the recent lows didn't even hit 170. Let's just use 170 now as our baseline, and we're just going to throw this up a little bit. Okay?
Mm-hmm.
So maybe we do something like this. Now that's $6.50 for the 170.205. You'll notice that I didn't bump this all the way up to 208, which is actually that upper band. One of the reasons is you'll notice that call is only about $1.14. I'm not crazy about selling options that go out in time where I'm not collecting at least 1% a month or thereabouts, 12% annualized. It's an equity risk.
Yeah.
This is the way I describe it. If you assume that equity returns are between 7 and 12% on average over a long course of time, if you take equity-like risk, you should expect to achieve rates of return that are in this neighborhood. Selling an upside call option that expires in 50 days for 0.5% is well below that lower threshold of 7.
Yeah.
Right? So I'm now saying, okay, well, if I want 7% annualized, that's going to be 58 basis points a month at least, which, by the way, is over a century's worth of equity returns. That's about what a monthly return would be. So you say, okay, I'm willing to, for 58 basis points a month, I would be willing to take equity-like risk, whether it's long or short, right? So the direction's the second part of this whole thing. So that's why I looked at the 205. So what is the 205? So that's 163, and we've got spot at 183. So that's 89 basis points, and we'll see whether my rough approximation is about right. So I said I needed 58 basis points, the bottom end of my equity risk rate return, and this has got 50 days to go. It's really 49. So we're going to multiply that if I can get this thing to clear. So I'm going to say 89. I'm going to multiply that by 30, divided by 49. And that gets me to 50. I actually get 55 basis points. So I was actually pretty close.
Yeah.
And yeah, so this is the reason I chose that. And that's that range. Now you're going to have a little bit of delta here, right? Because the call you're short is not going to have as much short delta as the put. So you're leaning long. And I think that's one thing to think about. You're going to get short premium. Do think a little bit about, where am I more comfortable taking risk? Am I more comfortable getting short the Russell up 10, 11% from here? Or am I more comfortable getting long the Russell, call it down 10% or so from here? And if the answer is I'm more comfortable getting long down 10 than short up 10, then just your strikes up a little bit,
yeah,
right?
That's right.
And go like that. So you're taking on a little bit. So Monday's Monday Morning Quarterback saying, look at April 25th weekly vol. Okay, we can do that. So there's this, those options, and let's take a look at the implied volatility first for April 25th weeklies. So I want to go to, let's pick that's not even a month. That's really you know what I need to do? Go like this. I need to actually look at the term structure to identify exactly what those are. So you are dealing with, and this is not surprising, you're going to see very high implied volatility. So the April 25th weeklies, yeah, those things are really juicy. Those are north of 40. Looks like they're 43.7,
Yeah.
8.5 clicks higher than the Mays. Now I want to point out that this is, the thing about this is, we do care about implied volatility, but it's not the only thing, because you can sell very high implied vol. I'll give you an example. Yesterday's implied vol in the S&P SPX options, I'm trying to remember exactly what it was, but it was, on the high side of 70, which is way above average. And you say, well, the S&P vol is never that high for any prolonged length of time. That's true, but within small windows, it can be exceptionally volatile. And in fact, this was the reason why I had a hell of a day yesterday squeezing that push out, managing my short gamma. And I'm going to illustrate this for everybody. Yesterday's intraday moves were wild. Absolutely wild. These types of movements here, it might be hard to divine this, but just how crazy this is. But imagine that if the S&P typically trades with a volatility of 10 to 15, okay? So if it typically trades even at 16 vol, that means its one-day standard deviation is 1%, and a one-day expected move is 80 basis points. And that's higher than a normal market condition would offer. Let's take a look at what actually happened. So in the morning, this is peak to trough, almost a 1% move, and that took place in less than 9 minutes. Okay? So a move bigger than the average. Here, we get a move of almost 1% up in 8 minutes. Then, right after that, we get a move down 1.1% in under 11 minutes. Okay? So I actually did a little bit of work on this, and depending on what kind of time slices you break it into, but just taking a look at local max min types of moves and slicing the time up, The actual volatility, if you annualized what was being experienced intraday, was about 100. And that's the difficulty when you shorten up if you're trying to sell premium, two things happen. You get short a ton of gamma. That's the first problem. The second is that the total amount of premium that you take in, so if things go wildly wrong, if you had sold upside in the Russell short dated call spreads 2 days ago, how did that turn out? I mean, that would have been absolutely brutal. We had one of the biggest rips that's ever occurred in my time in the markets.
Yeah.
This would profoundly affect short call spreads that expired in relatively short periods of time. Now, you're not talking about completely short. You're giving yourself a couple of weeks, or a week, I guess. What are we dealing with? Today's the 11th, 25th, so 2 weeks. 2 weeks out. But on an 11% move, the call spreads you'd have sold would have had to have been, they would have blown right through that. On the other hand, if you go out, 40, 45 days, it wouldn't have been as bad. And here's the other thing. Selling that upside, usually what happens when the market recovers, if panic is coming out of the market, implied volatility was going to come out of it too. So you will lose probably on effectively the gamma because you're going to be short deltas going up. But if you skew it slightly, the way we just described, you'd actually be leaning a little bit long. So you'd start off slightly long and then become short. But the vol crush might help you. Mm-hmm. So I think in an environment like this, and this goes to that whole thing I was talking about with Bruno, the chief quant at Bloomberg. You know Bruno Dupuy, right? I think you probably met him or spoken to him. You certainly heard him speak. He talks about this, the time vol arbitrage thing, where the short-term volatility is not this. It is not actually something that meaningfully translates to the process over longer stretches of time. Yeah. And so when you get really short gamma, I do like it in certain environments. I particularly like it when you have an identified catalyst and you have a fundamental view that the market is overestimating the associated move of that event. Mm-hmm. Like they think an earnings event is going to be big and you, for whatever reason, don't think so. But in general, in this environment, I think it's probably safer. Push those strikes out. Lean a little bit on deltas and give yourself more time to expiration. Those would be my recommendations. Then the worst thing that happens to you is in this case, $6.50 for that strangle, the one I just talked about. Short the 170s. So you get long at 163 on the Russell. That's down 11% from spot. You get more than that much exposure to the upside and a nice rate of decay. And if vol comes in, you win. I think I might go just push it out a little bit. That would just be my thinking. And that's coming from somebody who's been trading very short dated options on the short side 3 of the days this week. Yeah. I'm flat deltas now. I'm flat vol, mostly. Actually, I have some short puts on APA because you could sell I don't know if you saw this, but you could sell the 14 strike puts for $1.40 in APA.
Holy smokes.
Yeah.
I think you wrote that on the website, right?
I did. Yeah.
I like the company. They're a quality operation. Stock's trading dirt cheap. Never say never, but it's hard to believe level. There isn't much downside risk in the shares, even though the price of oil has come down.
Yeah. So this is where we're at right now. We're basically at five-year lows on or about. So yeah, I'm short oops, I closed my system. Which ones was I short? Trying to remember the expiration. Well, you can go to if you subscribe to the options edge, you can see what expiration. I think I'd actually selected some in the money puts, but I wrote the article on the night before thinking I was going to sell the 16.5s, but the next trading day I ended up selling the 14s. Okay. Personally. So that's the other thing. When you read these articles or you hear our comments, especially if you're dealing with a trading day away, listen to what we're saying in general about how we're approaching it, not necessarily the specific expiration or the specific strike or even a specific price, because prices may have changed by the time that you get to your own trading screens.
Yeah, whenever we talk
Okay.
about it, we suggest a strike. That should be in the context of whatever the share price was at that moment in time,
Mm-hmm.
right? So, and just for to say how far this share price has fallen, go back to 2006 if you could.
Oh yeah, 2008 was the all-time high in crude prices,
Yeah,
and certainly on a dollar-adjusted basis, and that was its peak. It's down like 80%.
yeah. So this kind of looks like it's forming a long base down at the
Mm-hmm.
bottom. And if we have this change in mindset about oil, remember now oil is evil, and there was going to be a massive shortage back in 2008. There was the idea of peak oil, and that which was a theory that said all the oil that is in the ground has been discovered already, and all there is for us to do from this point forward is to
Was it?
deplete that. And these guys did movies about what the world would be like, disaster movies, what the world would be like if there was shortages of oil and stuff,
Mm-hmm.
feeding into that panic. And now we're at the flip side of that coin, and that's why for the next 20 years I'm probably fairly interested in oil and gas, um, because I think that process of rejecting oil and gas is over. And
Yeah,
it's
what
going to
was the
start
guy's?
running
I
back
want to
up.
say the name was Hubble. I want to say Hubble, but Hubble's the telescope. It was not Hubble's theory of peak oil, was it? It was. It
Hubbert, I think.
was Hubbard. I said Hubble. Hubbard. Yes,
Yeah,
Hubble was the telescope. Hubbard was peak oil.
yeah,
Now, I would actually point out that this concept, the Hubbard peak concept, is something that often comes up in the context of all kinds of commodities. It is a really there's a natural tendency for a certain group of people to assume that, well, first of all, that wealth is derived from that it just sits around, right?
yeah,
So we'll start with this, like that there's money that's in the form of natural resources, and that their definition of it is that it is constrained in terms of quantity. There's a finite amount of it, and you use it up, and then when you've used it all up, you're screwed. And this comes up repeatedly in all kinds of contexts. Most commonly applied, I think, to oil, but it was certainly been applied to natural gas. And these two things are very closely related. But the reality is that what we have found is oftentimes it doesn't play out the way they think. What happens is that oil productivity declines, natural gas productivity declines, innovation steps in, they start looking for new ways to extract it, and then suddenly, rather than a shortage, we have a glut.
yeah.
Aubrey McClendon, who founded Chesapeake, and later killed himself in a car crash, but became a very wealthy guy. He was a victim of his own success, and for this very reason, we were facing shortages of natural gas. We started to import it from Canada. Fracking technologies came on the scene. He realized how much promise and potential they had, and he levered himself to the hilt to take advantage of this. And he did so to such great success that he ended up creating a glut of natural gas,
Yeah.
which ultimately proved to be his financial downfall. But he transformed energy production in the United States in that period, and the United States became what it once was, and most would have said was absolutely unimaginable, which was that we were going to be ever increasing our consumption of fossil fuels, and the amount we were producing was going to decline and decline and decline. We were going to become increasingly dependent on Russia, increasingly dependent on the Middle East. And what happened? We became the world's largest fossil fuel producer by a lot.
Yeah.
Saudi Arabia is second, and I believe in full year 2024 we produced in terms of barrels of oil equivalent, about 30% more than they did. And in fact, we produced in excess of our total fossil fuel energy use in full year 2024 as well. And that under the more restrictive policies of the Biden administration, which was one of the reasons why I said when Trump, drill, I thought, well, I'm not sure whether that's going to work out great, because on an inflation-adjusted basis, oil is actually not at super, super rich prices. Maybe we should just make sure we don't over-regulate and then let the market do its thing. If he wants to spur oil production in the United States, what maybe he could do is replenish the SPR, create a bid for oil prices, which will stimulate exploration and production.
Yeah, well, that probably wouldn't be a bad idea now.
We should. I mean, for national security reasons. Okay, so Monday Morning Quarterback, I hope that helps you. Good morning. How do you feel about the first batch of earnings? Does this predict how earnings seasons might play out? I traded JP Morgan to the upside. Well, I just mentioned Delta. Delta reported. They were the first to report. And their EPS beat. The guidance was, not overwhelmingly good, which helps explain the current share price. But I think I've articulated that I think, we never bottom tick anything. And I think that if you can find stocks that you think are the best operating in their space, they're trading at cheaper valuations than they typically do off of conservative estimates, that's going to represent a better buying opportunity. Could Delta go lower? Of course. But it's certainly a better buy than when everybody was screaming buy it. So I think you can do that. JP Morgan I rather like too, because I think they're the best at risk management. We've had this increase in interest rates. We know Bank of America has been terrible at that. Managing the duration in their HTM book. What do you think, Mark?
Well, I'm wondering if Delta's sandbagging a little bit because, their share price is down, so they'd like to have a reason to tell the world that the share price is down. And I personally think it's not their fault or anything that the share price is down. Share prices always have some fundamentals in it, and they always have a little bit of emotion. People start to discount the potential of a recession and less travel, but I still think there's still pent-up travel demand for people that didn't travel for 3 years during the lockdown. Because even after it was over, there was a lot of people that either didn't have the financial wherewithal or were reluctant to do that. So I think the travel industry is still in pretty good shape. And so it gives them the opportunity to look like a superhero by setting a low bar for the future, in terms of guidance, and then getting a nice big pop in the stock on the earnings announcement 3 months from now. So, that's the little cynical me that seeing how companies manage expectations, investor expectations, because they always want to, if they can, set a low bar so that when they beat it, they get to do a victory lap in there. And they're, like you said, the earnings number was pretty good. What they did was telling you that it's in the future. Well, maybe there could be a little weakness, and that explains our low share price.
I actually think it would be difficult for management not to make those claims right now. I mean, they have nothing to risk by saying the future could look choppy given the uncertainty.
Yeah.
The future's uncertain. It's certainly uncertain.
Yeah.
Given all the uncertainty.
Last we checked, yeah.
So on JP Morgan's case, look, I think they're best of breed. I think they're phenomenal at risk management. I think they're going to benefit from fees on the trading side, and that's a potential benefit for them. It's actually a relative benefit for them. So Morgan Stanley has focused increasingly on asset management. Asset management businesses are going to trade as a function of asset prices because that's how their fees are calculated.
Yeah.
But something like JP Morgan, on the other hand, because they're going to be trading volumes have been off the chart, as big as we've seen in the equity markets, their margins, when things get really wild, the relationship on fees associated with trading equities is a linear function of volumes. because that's the way they charge. They could say we charge 2 cents a share or 5 cents a share. You trade 1,000,000 shares, and that's going to be $50,000, and if you trade 10, it's going to be $500,000. That kind of thing. On the fixed income side, it's a dealer-driven market, and so when things get choppy, volumes rise, spreads rise, and oftentimes trading profits also rise. You have thoughts about that?
Yeah, well, we're seeing finally, what did we talk 2 weeks ago or 3 weeks ago that I hated high yield bonds
Mm-hmm.
because spreads were at historical levels and they finally started to widen out a little bit where they're starting to get a little bit more interesting. They and reasonably priced. I think there's probably a little bit to go. You're not sharing your screen if you were going to show us
Oh.
something. Is there?
Now I'm going. This is HYG, which
Okay.
is an equity-like proxy, but you can see that we've had a huge drawdown.
Yeah. Is there a way? Can you
Um,
grab the average yield spread in there somehow?
yeah, I have the. I had. So it's CDX5. Here we are. Here's the high yield spread. No, there it isn't. But this is the spread.
Okay.
I'll put this in linear form, and well, that's just coming right up for me. There we
Yeah.
go. Okay, makes a little more
So
sense.
so those are kind of
So this is the amazing thing. To your point, when you said high yield spreads were too low, that's where they were, and they were below average, well below average, and this is where they are now. What a difference a day or a week or two
yeah.
makes. This is where we are now. So now we're actually above average, or probably at or above it. I would say
What was it? 400 something?
we're at 430, 430 basis
Yeah,
points
I'd say
is
that's
the
probably the
5-year
long-term
spread.
average.
Yeah, so that's certainly more attractive.
So if you wanted to
And
dip your toe into high yield bonds because you need a little yield, so you're getting whatever. Let's see, the 5 years at 4.15. You're getting another four something, so you're getting 8, 30, 40%
do you
yield.
know the
That's
yeah? Do you know the approximate duration in HYG?
no, but it tends to be short. I think it tends to be issues 7 years and less by and large. But
I am seeing. Don't know if this is true. This is from the iShares website. I suppose they should know. It's their
yeah,
product. Uh, where did I see this? I just saw it. Where did it say? No, I have to do a search on the screen. I know I just saw the duration is sub 4.
okay. So the average maturity is
So
probably about 5, which means
yeah,
they're probably holding bonds with uh, times. Yeah, well, yeah,
average. Wow, look at that. Effective duration is 3.33 years.
yeah. So yeah, most high yield bonds don't tend to get issued in long duration. A
Mm,
10-year high yield bond is kind of going out there. And if you think about it from an investor standpoint, you're going to be nervous about going out too long because
yeah.
if things get worse, then the credit spread widens and you take a large price hit on your bonds. So, um, uh, it's
Yeah, this is
kind of
this yeah, this could be good. I mean, and actually, this probably the vol here has also gotten higher. So for people who are interested in trading options on it, where are we? No, what
I
am I
would
looking at?
guess.
Oh, whoops. I was just looking at the wrong thing. I saw a vol number that didn't make any sense. That was because I was looking at the vol on the CDS, which is definitely not what you want to look at.
Yeah,
It is higher. It's not high enough. I think you just go out and buy these things.
yeah. I think you need a
If
little
you
yield. It's okay to do that now with the piece of your portfolio.
yeah, because you're getting a benefit of two things. So what we've seen, the 10-year dipped into the threes. It's now about a 4.5, and then the spread widened out. So this is getting about 8.8 effective
Yeah,
in terms of yield right now. and relatively short duration. So that's something to definitely look at, I think, if people have not already. And we were talking about the rebalancing, gold up again. So you're rebalancing your portfolio because the yields were low, risk-free rates were low, because the credit spreads were low. This might be an area where you are under allocated. You can start to add. That doesn't mean dump all gold and buy all high yield, but it does mean that if you had a 5% allocation to gold, and net of the increase, it's now 6.5. You shed 150 basis points and throw that in here. I think that's a good play.
Yeah, I think you're right.
All right, let's see. Good afternoon, everyone. We get from DB. So we've been at this for about an hour. What kind of parting thoughts do we have for this weekend? And next week is a shorter trading week, because next Friday is Good Friday.
Yeah.
So the markets will not be open, and I'm assuming that we probably, I don't know if you're going to do something with PL next Friday and Wyatt, or what your plans are.
No, I'll probably be at home.
All right. So I mean, assuming I'm sitting here, I'm happy to do this.
We'll do this, not from my office, but from home.
Mm-hmm.
Yeah, I'm pretty sure I'm good to go.
Okay. So yeah, let's just talk about. I think we should probably summarize our comments here, because there's been a lot going on. So it does seem like the market is finally catching its breath a little bit, but vol is still high.
Yeah.
And I'm not going to say that there's no chance that we retest the lows. That's certainly possible, but valuations are a lot more compelling here. I like selling premium out about 2 months on index land, with a slight, don't short anything inside a 20 delta. You don't need to, by the way. You get a very attractive rate of return even at 20 delta. But maybe then just skew a little. My inclination is skew a little bit long deltas, because to me, if the risk is that you get put the underlying at an 11% down move, and maybe 13.5, 14 down net of the premium you collect, that's not bad. I mean, you're basically getting long most of these indices at that point at a 25+% discount to where they were trading only earlier this year.
Yeah.
And that makes a big difference, folks. I mean, if we don't think, just think about the multiple, and not just the multiple for what you think the full year earnings in 2025 is going to be, but really what you think the multiple is going to be over the next 10 years. What do you think the next 10 years are going to give you? Because if you're going to buy these things, that's probably what you're thinking. I'm going to buy it for 10 years.
I got lost your sound on my side.
Did I lose you, Mark? I think maybe I did.
Okay, keep going then. Jeff says you're still here. Me. All right, I can hear you again.
Not sure what happened there. I think something just interrupted my audio. Hopefully this will come back.
Yeah, keep going, Mike. I can't hear him.
But maybe we can just... Are you talking, Mark? You can wave and let me know that you are talking, or if you're good. Because actually, I lost my audio there for some reason. I'm not sure why. But we've used up our hour. So, yeah, sell a little bit premium, 45 to 60 days. And then when I'm done talking, Mark, I'll just be done. And you can say whatever it is you want to say. And you can give me a thumbs up and then, okay, let me know you're done, since I lost my audio here. But that's, I think, advisable. Dip your toe into HYG. Reduce a little bit on the big winners like GLD. Don't sell it. I'm long-term.
Okay.
I like gold. I still like the precious. And Mark, I'll now kick it over to you and let you sign off for everybody, since I can't hear.
I don't have any parting thoughts. I covered what I wanted to cover. High yield bonds getting more interesting. Fading vol might make some sense.